Ever wondered where money actually comes from? While the image of giant printing presses churning out fresh banknotes is a powerful one, the reality of how governments print money today is far more complex and digital. This process, shrouded in financial jargon, is one of the most powerful tools a government can wield, capable of shaping economies and influencing the lives of millions. So how does it all work, and what does it mean for your wallet? Let's unravel the modern mystery of money creation. The days of simply running the physical printing presses are largely over. Today, the creation of new money is primarily a digital affair, orchestrated by a country's central bank, like the Federal Reserve in the United States. This process is often called quantitative easing. It begins when the central bank decides the economy needs a boost. Instead of printing physical cash, it digitally creates new money in its own accounts. This new money is then used to buy financial assets, typically government bonds, from commercial banks. When the central bank purchases these bonds, it credits the commercial bank's reserve accounts with the newly created digital funds. This infusion of cash doesn't go directly into citizens' pockets. Instead, it increases the reserves of commercial banks, giving them more capital to lend out to businesses and individuals. The goal is to lower interest rates and encourage borrowing and spending, thereby stimulating economic activity. This power to create money out of thin air has profound economic impacts, acting as a double-edged sword. On one hand, it can be a vital tool for pulling an economy out of a recession. By making borrowing cheaper and encouraging investment, it can stimulate growth, create jobs, and prevent a financial crisis from spiraling out of control. However, the most significant risk is inflation. When the money supply grows faster than the economy's production of goods and services, the value of each dollar decreases. This means your money buys less than it used to, leading to a higher cost of living. Furthermore, this process often involves the central bank buying government debt. This can make it easier for a government to run large deficits, potentially leading to an unsustainable national debt burden over the long term. The challenge for central bankers is to strike a delicate balance, stimulating the economy just enough without unleashing runaway inflation. In the end, the concept of printing money has evolved from a physical act to a sophisticated digital operation with far-reaching consequences. It is not a simple fix for economic woes, but a complex monetary policy tool used by central banks to navigate recessions, manage financial stability, and influence the national economy. Understanding this mechanism is key to grasping the invisible forces that shape inflation, interest rates, and the overall health of our financial world. It is a powerful lever of modern finance, and its use will continue to be a subject of intense debate and scrutiny for years to come.